Okay, so we have a special kind of deferred expense to consider, and it's called depreciation expenses. Anybody ever heard of the term depreciation? Okay, so this book gives what I consider to be a not very good explanation of it, just from my opinion. So depreciation is an accounting term when we're in accounting class. It has nothing to do with an asset losing value, because sometimes an asset could be worth more, like a house. It could go up in value, okay? But it has everything to do with us allocating the cost of the asset over its useful life. So in other words, if I buy a computer and I think it can last 4 years before I have to replace it, and I pay $1,000 for it, again, do I want to just take $1,000 expense this year? Or is it better to take a $250 expense for the next 4 years and recognize that that cost of that computer is spread out over its life? And the answer is, it's better to spread it out, because we're probably earning revenue from the use of that computer somehow over the next 4 years. So we have to, the matching principle tells us to spread that out. So depreciation is the process by which we recognize the cost of an asset as an expense spread out over that asset's useful life. Okay, so we depreciate what are called fixed assets or plant assets. Usually that means each company has a slightly different, they'll kind of set the parameters, but like here at EAC, if an asset costs more than $1,000 and is expected to last more than a year, then we call that a fixed asset, as opposed to a supply, which is something that is expected to just be used up. Okay, so the most common fixed assets that you deal with will be land, building, equipment, that sort of stuff. Those are the fixed or long-term, you sometimes see them called long-term assets. For whatever reason, the IRS does not recognize, and therefore we do not depreciate land, but we depreciate all other fixed assets. Yes. So depreciation means I'm trying to not use giant accounting terms, the allocation of the cost of an asset over its useful life, or the taking as an expense the cost of an asset over its useful life. I would actually say you're expensing the asset. Okay, you're actually taking, so I'll give you an example here in a minute. But again, if I buy this computer and it lasts for 4 years, instead of charging myself $1,000 expense today, I'm going to spread that out over the next 4 years and do $250 a year. That's what depreciation means. Okay. To do this, we create a special account called accumulated depreciation. And that is how we track, because what we're going to do is we're going to leave our asset account always at the cost, and then we're going to attach this second account to it to track the depreciation, called an accumulated depreciation account. And they're giving you a new term here. An accumulated depreciation account is a contra account, in this case a contra asset. Okay, and all contra means is it's an asset account, but that has a normal balance on the credit side, on the opposite side of the regular normal balance of that account. Again, when I give you an example of how it's used, that will help. All right. Let's see, that doesn't give us a great example. So, yeah, that's not great. It just says Net Solutions office equipment depreciates $50 during December. So our entry to recognize that depreciation is going to be that we'll debit depreciation expense $50, and we'll credit the accumulated depreciation account $50. I don't think that's really helpful. So let me give you this example with the computer. So when I purchased the computer, I'm going to call it computer equipment. When I purchase it, the asset computer equipment goes up by $1,000, and my cash, right, would go down by $1,000. So that'd be my initial entry when I purchase something like a computer, is I would debit the asset computer equipment, credit the asset cash. That'd be the first entry. Then what I have to do to figure out depreciation is I have to make some estimate as to the useful life of it. So in real life, accountants do that. They just have to make some estimate. So we made an estimate of 4 years. So we're going to say, if it costs $1,000, we're going to divide that by its useful life, That's going to tell me how much depreciation I will do per year. Okay. If I was doing monthly books, then I would have to divide that by the number of months in 4 years, right? To figure out how much monthly depreciation I would do. Okay. So we're going to do an annual book. So we're going to do $250 per year. So at the end of the first year, what I'm going to do is I'm going to debit what's called depreciation expense, $250, and I'm going to credit accumulated depreciation account, $250. And so there's a separate accumulated depreciation account for every asset I have. So this one's called accumulated depreciation, computer equipment. Okay. I'd also have one for building or for trucks or whatever I was depreciating. So after I do that, you can see I didn't change my computer equipment account. Its balance stays the same as my cost, but I'm going to have another account called accumulated depreciation. I'm just going to call that AD computer equipment. And now that's going to have a credit balance of $250. Accumulated depreciation accounts are always linked to their specific asset. Okay. So the accumulated depreciation computer equipment account is linked to the computer equipment account. And so the term that you'll see come up is book value. If someone says, what's the book value of an asset? It's the cost of the asset minus its accumulated depreciation. So after 1 year, our computer equipment book value is going to be $750. And it'll actually show on the balance sheet. It'll say, in the asset section, it'll say computer equipment. And then there'll be a second line that will say less accumulated depreciation. And then it will give you a total of $750. Okay, 1,000 minus 250. At the end of the second year, we're going to do this exact same adjusting entry. So now this will have a balance of 500. And at the end of the third year, we'll do it again. And at the end of the fourth year, and now we'll say that asset, computer equipment, is fully depreciated. It doesn't mean it's worthless. Maybe the computer's still working. Maybe we're still using it. What it means is we have fully claimed as an expense the cost of that computer. Again, don't get into your head that we're talking about the value of it or the usefulness of the item. That's just an estimate. Some computers might last 10 years, right? I don't know. But based on past experience, we had to make an estimate of 4 years. And so that's how we claim the expense of it. So all we're doing with depreciation is we're claiming the expense of the cost of the asset spread out over time. That's all. As you do more, again, I see some of you look worried. Don't worry, you can do this.